Like what you're saying is the new normal, the term you coined, is still the case, that whatever hopes for growth the markets are pinning on fiscal policy and Donald Trump aren't going to be realized.
Hi, Mike. Yeah, I think so. You know, it's hard to measure exactly what the stock market is pricing in terms of real growth, but the Trump objective is certainly 3%, and perhaps, you know, market makers and investors are thinking in those terms. All I'm suggesting is that growth, which is a function of labor force growth and productivity growth, basically is turning out to be closer to 1% as opposed to 3%. Productivity growth has been 0.5% for the last 5 years. And, you know, Janet Yellen a few days ago in a question and answer session said basically that she doesn't know why that's the case, but she hopes that productivity will be higher. Well, you know, lots of institutions and authorities suggest that there are reasons why productivity will not return to the 2 to 3% rates of growth before Lehman. And so, you know, I simply caution investors to think in those terms. If we don't get 3% growth, what does that mean for corporate profits? What does it mean for high yield spreads? What does that mean for risk assets going forward? I think it means that they might be overpriced.
Well, I'm wondering if they can get there some other way to justify the valuations, because certainly over the last 6 or 7 years, we've only had an average of about 2% growth. And yesterday you had Trump talking about wanting lower interest rates, wanting a weaker dollar. Can we get it without boosting growth from other means? Can corporate profits gain?
Yeah, I think those are positive factors. You know, deregulation and the corporate tax reduction possibility are certainly factors. You know, let's not forget that. Lower interest rates, you know, are part of that equation too. So it's not just a one-sided type of affair. But I think growth in terms of risk assets is the dominant force that will either propel stocks forward from here, or you know, keep them, you know, rather flat or even down over the next 6 months. And if we don't get 3% growth, then corporate profits don't grow at 5 to 10%. They need at least 2% GDP growth in order to really go up. One of the reasons why stocks have done so well in that type of environment, like you suggest, is that corporations have used their cash flow to buy back their own shares as opposed to invest in the economy. And ultimately, if they don't invest in the real economy, then productivity growth stagnates, and that's really what we've seen for the past few years.